We are making a pretty big pivot in our $375,000 income-focused account. And today I'm going to share a full reveal of how we plan to significantly boost our passive income. Imagine waking up to discover that you can double your income from your investment portfolio without significantly increasing your risk. Sound too good to be true? Stick with me to find out. And if you're new to our channel, hi, I'm Stefanie. Welcome to Permission to Be Wealthy, where my partner Joseph and I have open and honest conversations with you about what it's like to build wealth, to invest, and to pursue financial independence with balance. We've been living abroad for 7 years, 3 of which we've been navigating as a financially free family of 4 right here in beautiful Portugal. Today, we're diving deep into a major portfolio update. In our last video, I hinted at pivoting from our previous income strategy, and today I'm going to share exactly with you what we're planning to do. We're going to do a level set on our short-term and our long-term income goals. I'm going to walk you through our overall investing strategy. We're going to zoom into our income-focused account, what it was, why we're making the changes, and what we're moving to. And if you stay to the end, I'm going to reveal exactly what we plan to do to double the income from our covered call ETF and income-focused accounts. This is a new strategy. You don't want to miss some of the projected numbers and some of the changes that I am expecting in the long term. So first things first, let's talk about our income goals. It's crucial to know what you're aiming for before you pick your investments. And I also want to remind you that our goals may be very different than yours. It's important to understand your own risk tolerance, the length of time that you have to meet your goals, and how you feel about the journey towards those goals. I am not a financial advisor, and you are responsible for your own research. So let's get into it. Our short-term goal for expenses is around $120,000 per year after taxes. And I want you to remember this is for our family of 4 who have kids in international private school out here in Portugal. It's currently broken down into 3 main buckets. $60,000 of active income. This stream is all about growth as we build our real estate company here in Portugal. We expand this very YouTube channel, and Joseph continues to go back to Texas to focus on real estate there as well. Then there's $40,000 from our income-oriented account, and this is the big one for today, growing the passive income strategy with the consistent amount of money over time, allowing it to become a significant pillar of our financial independence. We're also planning to sell a portion of our index funds, about $20,000 a year. This is testing our retirement phase, allowing to see how it feels, how it impacts our overall taxes. Ideally, we want to reduce this to 0 until we're 50, but currently it's well below the 3% withdrawal rate, giving us some comfort. And beyond that, our longer term vision is even bigger. We're aiming to take our over 400,000 in retirement accounts and grow them to over 2 million by the age of 60, allowing us to kind of coast into comfortable retirement. For these, we're investing primarily in broad-based index funds, we're reinvesting all of our dividends, and we're focusing purely on long-term compounding. Then there's expanding our core growth account. Our 400,000 core growth account is targeted to hit 1.3 million by the time we hit age 50. We're 41 now. This is going to support around $50,000 a year at a conservative 4% withdrawal rate. Similar to our retirement accounts, these are also invested in broad-based index funds where we're reinvesting the dividends and maximizing the growth there. The focus for our current 375 income account is to maintain about 4% in capital growth annually. We want to generate about $40,000 in passive income after tax from that account. And this is about balance, maximizing income, maintaining moderate capital growth, optimizing for taxes. And this, my friends, is what we're going to focus on today in the further part of our discussion. And I won't forget to mention, we plan our active income streams to scale to $100,000 a year post-tax, evolving into a more passive operational model over time, giving us incredible flexibility as a family of 4 who still has young kids with a lot of life to live. So everybody's journey starts somewhere, and ours with income investing was no different. We began with our foundational approach, our core index funds, and as we grew our wealth and we decided to make some big changes in our jobs, where we lived, our overall lifestyle, we added the income-oriented part of our strategy after we sold a massive asset, our rental home back in Texas. And we've learned a lot of things along the way. So let's zoom in on what our income-focused account looked like before. This was our old mix, and it definitely served its purpose by generating cash flow flow, but as we look closer, we learned some key lessons along the way. Our initial portfolio was pretty simple, mainly comprised of JEPI, QYLD, XYLD, and RYLD, aiming for consistent high yield. The idea was straightforward, get a lot of income. But as we invested, we quickly uncovered some important nuances about these high yield covered call ETFs. These were our trials or our challenges that ultimately led us to rethink our strategy and to find a new path. We learned that chasing the highest yield wasn't always the best strategy. And while that income was high, we noticed that the capital value of the underlying asset wasn't growing or even declined in some cases, like with RYLD specifically. You might be getting some great income payments, but the value of your initial investment is shrinking, and that just wasn't working for us. The way these funds distribute income can also have different tax treatments. While we weren't super frustrated with the taxes initially, we also realized that there was potential to optimize here that we didn't want to overlook. And understanding how these generated income by selling options against their holdings is key. It's not just magic money. These are generating income by selling away some of the upside potential, which leads us to our biggest learning. And this one was a huge one for us. When you sell covered calls, you essentially cap your upside growth. And if the market rockets, you don't fully get to participate in that rise. And that was significantly impacting our total return, at least how we were looking at it. And this was especially true with the funds that sell 100% covered calls across 100% of the portfolio, like some of our previous holdings. We wanted to ride the market's waves a bit more by still getting some of that income. So after these learnings, we decided to revisit our approach, and it's a strategy that allows us to truly double our income, I think at least for the short term, while we're addressing the challenges that we faced with the capital appreciation and the tax efficiency along the way. Now, I also plan on walking through the details of this exact spreadsheet that I used for all the calculations in an upcoming video that would just take too long for today, and I'll explain how I'm coming to some of my analytic conclusions, so be sure to subscribe if you want to geek out with me on that. Our new mix focuses on a refined approach with 4 key players: QYLG, XYLG, DIVO, and JEPQ. And so let's break those down. QYLG, Global X's NASDAQ 100 covered call and growth ETF, makes up 40% of our mix. Similar to QYLD, but with a big difference. It only covers 50% of the options, meaning we get a significant amount of income, but we also get to participate in half of the market's upside growth. This is a game changer for us in terms of being able to maintain capital appreciation while still getting income from the tech sector. Now, I know that the yield is high at 26.38%, and I don't expect that to be the case forever, but at a minimum, I expect the fund to generate at least 11 to 12% over the long term, which still fits into our overall 40,000 overall income goal for this account. Next, we have XYLG, Global X's S&P 500 covered call and growth ETF at 20% mix. This is the S&P 500's equivalent of QYLG. Again, that critical 50% options coverage means we're still capturing broad market growth on half of the investment portfolio while generating income along the way. This is also bringing essential diversification and broad market exposure without completely giving up on all those market rallies. And I'm watching the yield, which is 24.91% at the moment, for the same reasons that I'm watching QYLG's. DIVO, the Amplify CWP Enhanced Dividend Income ETF, is 20% mix. This is a managed ETF that focuses on strong dividend paying companies and tactically sells covered calls. This isn't just a covered call fund, it's an active management strategy that seeks strong yield and capital appreciation by focusing on quality companies. For us, this is the fund that's going to balance the growth part of the overall account while keeping it tax optimized. And lastly, we have JEPQ, JP Morgan's NASDAQ Equity Premium Income ETF at 20% mix. JEPQ is an established fund from JP Morgan, similar to JEPI, but focused on the NASDAQ 100. It is known for its strong dividend payouts and seeks to provide consistent income along with potential growth from tech-savvy companies, which aligns perfectly with our goals of both income and capital resilience. So you might be asking why the new mix, and it comes down to a few core reasons. Number one, we didn't want to overcomplicate things. This mix creates something that we can truly understand, especially as I continue to look at how the dividend plays out with QYLG and XYLG, and I'm betting that it's going to level out over time, but it'll certainly play in a range that's going to still allow us to maintain our goals of that $40,000 per year. Then there's the 50% options coverage, and this was key. It's the sweet spot where we're generating income while also participating in the market upside, directly mitigating the capped upside issue that we were experiencing experiencing before, and it's a fundamental shift in how we're approaching covered calls this round. Funds like QYLG and XYLG often have lower expense ratios compared to their 100% covered call counterparts like QYLD and XYLD. This means that more of our money is staying invested and working for us rather than going to fees. Granted, I wouldn't be surprised if the fee went back up at some point as the fund gains ground, something that I'm aware of and I'll continue to monitor. And our goal isn't just income, it's to maintain and even grow our capital. We're aiming for moderate capital growth on top of the income for the hold account, around 4% per year, and that's why we have Devo in the mix. This combination is projected to give us a robust and, more importantly, sustainable income yield. While we expect that the initial high payouts from QYLG and XYLG to normalize over time, the overall mix is designed to consistently help us meet that 40,000 plus some. And lastly, the specific strategies employed by these funds, having a higher portion of qualified dividend income, is going to allow us to have more efficient tax strategies, and it'll obviously depend on what your tax bracket is over time. So let's look at the numbers. This is where it gets exciting, and based on our current yields and our capital, here's a side-by-side comparison of our old strategy versus the new one. And this is how we project to double our passive income in this specific account for at least the next 1 to 2 years. And as I showed in my overall dividend recap a couple of weeks ago, I expected to make about an average of $3,262.78 per month in 2025 with our original strategy. With this new mix and based on current yields, I believe that we're going to see over $6,500 per month. And while I expect the yields to normalize over time, it's a significant boost to our overall total return approach. The shift isn't just about getting more dollars, it's about understanding what we're invested in, looking at the overall return, taxes, fees, and what we're expecting the funds to do in the future and going forward. And remember, things like SCHD, broad-based index funds, and others are in our other accounts. If you're interested in seeing some of that, let me know in the comments. So before we wrap up, if you're finding this portfolio reveal helpful and insightful, please take a quick moment to hit the like button. It really helps our channel grow and lets us know that we're creating content that you love. And if you haven't already, be sure to subscribe to the channel so that you don't miss the next financial journey update and our portfolio deep dives. So what are the key takeaways from our portfolio evolution for smart investing, especially when it comes to income? These principles are simple but powerful, and they are lessons that we're constantly revisiting. Number one, don't just chase the highest yield. Always dig into how an investment generates its returns and what its inherent trade-offs are. High income often comes with trade-offs like capped upside or capital erosion. It's like buying a car. Just because it has a good engine, you really have to make sure it has good brakes. And always focus on total return. This is your true measure of overall wealth accumulation. It's your income plus any capital appreciation or minus any depreciation, and it's the full picture, not just one piece of the puzzle. And align every investment, and I mean every investment, with your personal financial objectives and your unique timeline. What's working for us might not be working for you. Your goals, your risk tolerance, and your financial journey should always dictate your strategy. Make sure to do your own due diligence and research. I definitely plan on doing another account recap after the next round of premiums and dividends come through from this new diversified account. So stay tuned and see how this new strategy performs in the real world. If you're just getting started on your investing journey and want a solid foundation, you can check out our free investing guide on how to get started. I've linked it in the description below, or you should see it popping up somewhere right here above me right now. And you know the drill. For all the nitty-gritty data I used in today's video, the old mixes, the new mixes, the current capital, the projected income, I keep that Google Sheet available for you to check out in the description below for 1 week. So if you're a data nerd like I am, definitely check it out below before it's gone. And be sure to like and subscribe so you know when our next chat's gonna be. As always, I hope this video gave you a little bit more food for thought on how to give yourself permission to be wealthy.